Hello and welcome. Moss Adams is pleased that you joined us for today's session, Private Equity Funds Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I'd like to introduce today's moderator, Syed Rizvi, partner here at Moss Adams. His bio and contact information, along with our other presenters, are located in your webcast console if you would like more information. And now I would like to turn the floor over to Syed to get the presentation started.
Thank you, Danielle. Hello, everyone. Thank you for joining us for our 2022 Private Equity Funds Update. Today's presentation will generally be divided into 4 parts. The first part would be led by Sterling Smith, who will talk about our PE observation outlook for 2022. After that, we will have a tax update provided by Jason Munn, our tax partner. After that, we'll follow up with international tax update by Brittain and Stu. And we'll end the presentation with Dylan Peters talking about accounting and regulatory updates as it relates to private equity funds. So again, thank you for joining us. Q&A function is open, so we will be taking questions live. And if we don't get to your question, we will get back to you after the presentation. So with that, Danielle, I think we can go to our first polling question.
Yes. Let's see. We'll start with our first polling question here. After a record-breaking year for private equity investors in terms of closed deals in 2021, was flow defined as number of investment opportunities reviewed in the first 6 months of 2022. A, greater than the last 6 months of 2021. B, approximately equal to the last 6 months of 2021. Or C, less than the last 6 months of 2021. I'll give you a few moments to respond. To respond, please click the button next to the answer you choose and hit Submit. If you can't see the Submit button, please enlarge the slide area. Give you all a few more seconds here to respond. And here are our results.
Good morning.
Thank you,
This is
Danielle.
Sterling.
Yes.
Okay. Good morning. This is Sterling Smith. I'm a director at Moss Adams. Primary focus is on private equity, a lot within the due diligence services that help facilitate the entrance and exit of deals. Before I jump into the next section to give an overview on kind of the state of the union of the private equity environment and outlook for 2022, just want to hit on this polling question, which really I think a key here is there's not a hard and fast answer. It's more anecdotal. Based on the various conversations I've had with private equity professionals, investment bankers, some of the industry publications such as PitchBook, the actual answer, which is shown here at about 35%, about 1/3, it's actually deal flow has been greater this year, which is, a little mystifying when we start talking about how active 2021 is in the next slides. But it's kind of twofold. A lot of feedback is that there is more deal flow, but lower quality names in terms of companies coming to market that just aren't as strong as what we're seeing in the calendar 2021 year. Let me jump forward here. Okay. As I touched on, the next few slides, I'm going to cover, some of the private equity observations and thoughts around 2022 as well as 2023. So I'm assuming this won't be lost on too many people who are on this call who saw the frenzy of deal activity of, funds both making acquisitions and selling companies in 2021. As the statistics say here or show here, in 2021, it was definitely the most active M&A period in more than 10 years, resulting in over 9,000 closed deals and an aggregate value of 1.2 trillion. Again, there hasn't been a number of private equity-led deals close close to the $1 trillion market in over 20 years. Actually, my former background was an investment banker, and I spent, 20 plus years in and around deal making and never saw an environment that was anything like last year. Telling into 2022, the first half of the year slowed, but it all has to be taken on a relative metric. First half of 2022 was actually probably stronger than the first half of any year in the last 5 or 6 years other than 2021. And you can see here that we closed, or private equity groups closed almost 4,000 deals, which is close to kind of the halfway mark you would have seen in 2021, but was a little bit different as deal sizes came down. And I think a lot of that had to do with there were still some large deals that were closed in Q1 that were a trail over from the active 2021 year. And then you also saw some companies being pulled out of the market in first quarter of 2021 as we started to exhibit some concerns around the economy, interest rates, the war in Ukraine, which we'll talk a little bit more in a minute. In general, the private equity community, again, this is based on conversations I'm having pretty much daily with both investors, bankers, other intermediaries. There's a lot of question as to whether or not we'll see a notable slowdown in the second half of 2022. And I think that from what I'm hearing, that it's realistic, but at the same time, and we'll talk about some factors on the next slide, there's still a strong environment for M&A activity and deal making. And I fully expect that we'll still see quite a bit of activity as we kind of round out the rest of this year and going into 2023. But definitely a lot more doubt about what next year holds. But no one's crystal ball is that good, so we'll just have to wait and see what time tells and what happens from sellers deciding to hit the market. In terms of key drivers and risks to, let's say, the rest of this year, and really now at this point, I think as we sit here at the end of August, we start focusing more on 2023. I think I really have to start by addressing the key risks, and then I can counterbalance that with the drivers that I think will support, a good environment despite some of the headwinds. So, and the first thing to hit is inflation. I think it's pretty confident that everyone on this call is feeling some inflationary pressure, whether it's at the grocery store, energy cost, at the pump. Again, nothing new there, but it's something that's having a ripple effect. And again, the Fed has tightened interest rates through 2 cycles now. They're meeting in Jackson Hole, Wyoming this week, and from that meeting, there's probably on the fence of whether or not we have, a third 75 basis point interest rate increase or a 50% increase. Again, I don't have a crystal ball that's any better than anybody else's, but from my perspective, you read the markets and they say it's kind of 50-50 as to whether we get 50 or 75 basis points. Either way, you're going to have higher borrowing costs, and a common theme within private equity discussions is, when and how bad will Fed break the consumer? And again, that's via increasing interest rate, taking liquidity out of the market. And as that plays out, the question is, soft landing or hard landing, hard landing being, that a situation where we actually cause a recession in the economy. Recession fears, there's a lot of things driving that. War in Ukraine, logistical challenges that have stemmed over from COVID, just in terms of sea freight, offshoring. There's obviously challenges going politically with China and some of the supply chains in the Far East, and then labor markets. I mean, it's hard for anyone to call a recession when you have employment as low as it is today. But on the flip side, the biggest challenge I hear constantly from anybody in the private equity community is getting the right resources, human resources in place to be able to grow and manage their businesses. The bright side of the equation are the key drivers listed above. And the biggest driver is the old conundrum of supply and demand. And when I say that, there is so much dry powder, trillions of dollars in both debt and equity capital available to pursue deals that it's interesting to hear investment professionals kind of lament about, it's really hard to find a company that doesn't have, 12 other suitors, and everyone seems to have plenty of capital to pursue them. So, the dry powder, I think, will continue to drive the M&A landscape and keep it active. I think that's probably the biggest floor we have. And then, I'll just touch on 2 other points, which is there's still a lot of retiring baby boomers that are, entering the market to sell their business. And then a lot of those companies tend to be a little bit smaller, and those tend to fall into the add-on acquisition, which supports a lot of private equity buy and build strategies, which are happening across all industries and across the country. Just to kind of speed it up a little bit here, question, is it a seller's or a buyer's market? And really just depends. If it's a quality asset, they're still receiving very high premium valuations, very robust banking processes. If you look at the strategic activity within the competitive landscape of buying businesses, corporates have been definitely less active first half of this year, which has allowed PE buyers to be more active. But when you take strategics out of the equation, that tends to allow PE buyers to be a little less aggressive on valuations. So again, sellers aren't getting as much for their business as they would want, and that's kind of causing some not even to go to market or maybe test the market as opposed to being full in on the process. I touched on it earlier, but add-on acquisitions are definitely the majority of deals that were closed in the first half, and that's kind of expected through the rest of this year. And then an interesting, probably more interesting now than has been in the last 2 years, when you look at sellers' projections, much higher scrutiny, COVID, recession-proof, A lot of different factors there that are part of the underwriting process for the investment committees of private equity groups. And then, a lot more in structure in terms of earnouts, which is, from a seller's perspective, kind of a bad word. Creates a lot of fear and uncertainty of what they actually get paid for their business. But the earnouts is definitely more in favor. I'd say a third of deals are seeing it, whereas like 2 years ago, they were non-existent. And then, a seller actually having to put paper into the deal in terms of help financing it. You're seeing that more as the credit markets have gotten more expensive. I think the last couple of things I want to touch on here is in navigating the M&A environment today versus 2021, a lot of deals spilled over into 2022 first quarter because investors just couldn't get deals closed in time because they couldn't get their diligence done. And that's also not just financial diligence, tax diligence, it's underwriting for reps and warranty insurance, it's legal, just papering the transactions and the risk management that goes in the reps and warranties. So there's been an ease of that, but I would still say from Moss Adams' perspective, we still feel like it's a little bit like 2021 as our groups are still being fully deployed across a spectrum of transactions. On professional services, I think everyone complains about it. I think, at least from Moss Adams' perspective, we have real costs that have gone up in terms of recruiting new professionals. Again, it's a labor battle. Retention has required, increased salaries as we are a elevator asset business. We have to make sure that our professionals are, compensated to market. And then that's kind of flowing through to increase in prices where, Q of E services may be 30, 40% higher than they were even in 2021, which was kind of a little peak pricing, just given capacity constraints. I think that's something that's continued to tell on into this year and even next. And then the last comment I'll make is on LOI signature to closing. Those timelines seem to be running a little bit longer. And I think the biggest driver there is still getting resources. And I think the underwriting that happens in investment committee is just becoming more and more challenged. There's just uncertainty with the inflationary impacts, potential recession. Again, Ukraine still hangs out there. Not to be like the bearer of bad news, but these are real risks when you're going to own a business for 4 or 5, 6 years. And it's just a reality that we're all facing. So with that, that's kind of the update that I wanted to present today to keep us on the timeline. And I will turn it over to Jason Moon for the tax update.
Very good. Thank you, Sterling. Again, my name is Jason Munn. I'm a tax partner in the firm. I spend most of my time working in the financial services space. I obviously focus a lot of my time in the private equity funds tax space as well. Today, I want to focus on 2 things primarily. We don't have a lot of exciting tax updates, but we do have some things that I think are important for you to understand as we look to where tax legislation could go in the future. So I wanted to touch on 2 things. First, the Inflation Reduction Act, new law that we have to deal with. And secondly, a quick reminder on the qualified small business stock rules and considerations going forward. So let's talk a little bit about the Inflation Reduction Act. As many of you know, that was signed into law about a week ago, actually, today on August 16th. But before we talk about the actual law and what made it into the final bill, I think what's important for this group and really most critical is let's talk about what was almost in the bill. As I'm sure a lot of you heard, there were proposed changes in the carried interest rules that were in this bill pretty late into the process. However, on August 5th, a few weeks ago, due to some compromises with Senator Simona in Arizona, the carried interest proposed rule changes were dropped and did not make the final bill, which is great for this group, so we can continue to see those favorable tax benefits that have been available for carried interest for a number of years. But Let's dive into that a little bit and let's understand what those proposed changes were, because I think it's important as we continue to see kind of the continued erosion of these tax benefits. The provisions expanding the scope of Internal Revenue Code 1061 are a lot of what we saw in the proposed language. And that code section was originally included in the Tax Cuts and Jobs Act back in 2017. This was kind of a takeaway, a revenue raiser item that was tucked in to offset some of the tax cuts and other things in that provision. So what that did was to start that process that we're seeing, that we're continuing to see today, is again the erosion of some of those benefits with the carried interest being taxed as capital gains. It's also important to realize that some of this, the limitations on the carried interest rules, in particular with Section 1061, were some of the same provisions we saw in the Ways and Means Committee language early on in the Build Back Better Act last year in 2021, which of course was never signed into law. And in its final kind of incarnations, once it got to the end of the process, again, the carried interest rules changes were dropped. But again, the point I want to drive home is that, this is twice now in 2 years where we've seen potential changes, for the negative, if you will. So let's talk real quick about current 1061 guidance. Again, what the Tax Cuts and Jobs Act did was to put a 3-year stake in the ground and said to get the long-term capital gains on the disposition of certain investments, you had to hold it for at least 3 years. That didn't exist before the Tax Cuts and Jobs Act. So that was kind of the first situation where we've seen where there was some pullback on the benefits to the carried interest characterization as capital gains. What we saw in this, in the Inflation Reduction Act, was that 3-year period expanded to 5-year period, to a 5-year period. And while that may sound somewhat harmless, as with a lot of tax legislation, the devil is in the details. And tucked down at the bottom of the slide, you see this term, the substantially all requirement. And really what that does is it takes that 5-year holding period and potentially makes it longer, because the way those rules were written, it said that the holding period begins on the later of the date the taxpayer acquired substantially all of the partnership interest subject to Code Section 1061, or, and this is the part that's troubling, or the date on which the partnership acquired substantially all of its assets. So what that means is that you're looking at the investment period itself, and that really is the driver of when that 5-year period starts. So like a typical private equity fund might have a 3-year investment period. So if you have something that you buy in year 1, well, if it takes the partnership 3 years to buy substantially all of its assets, then you could be at the end of 3 years before the 5-year window starts, which would have effectively made it an 8-year total hold. And that's obviously problematic. And a traditional hedge fund with maybe no defined investment period, at that point, it seems to negate the carried interest benefit, because you're never going to meet the substantially all requirement. So as you can see, there's, thankfully, this was not enacted into law, but it's really the second time in the last couple of years that, these carried interest provisions again become subject to proposed legislation and potential changes in those rules, which are not positive changes, obviously. Let's talk about other proposed changes that were in the Inflation Reduction Act. Again, none of the things on this slide were enacted into law. They were just proposed changes. And again, I just want to highlight the continued scoping changes of Section 1061 and those limitations. Currently, the rules exclude certain types of gain, such as 1231 gains, regulated futures gains that are marked to market under Code Section 1256. Those all would have been pulled under the scope of 1061. So now you would have had the holding period and other rule requirements applied to those as well. You would have seen the denial of long-term capital gain treatment on enterprise value. I think you typically see this where you would have a situation where profits interest units are granted in a parent entity. The profits interest units are within the scope of 1061, and thus in those situations you might have trouble again satisfying that substantially all requirement if there was no fixed investment period. The other changes, let's see, what else do we have here? Would have been gain recognition provisions on transfers of partnership interest, which could impact M&A activity and other planning that might be ongoing. So really, there were a lot of proposed changes here that thankfully did not get through to the final legislation. So what does the future hold? One word really would be uncertain. Again, we saw the erosion of the carried interest benefits starting to creep in back in 2017 when the Tax Cuts and Jobs Act was signed into law. And as you all know, it gets a lot of press as a big loophole. And so we continue to see this as a bargaining chip in a lot of legislation. So, it's been sidestepped this time, but I think we will continue to see it be an issue going forward. All right. So let's talk real quick about the items that were signed into law. And it says other tax impacts. It really should say actual tax impacts, I suppose. These are the things that made it into the Inflation Reduction Act as signed into law, which I wanted to highlight very quickly. Let's see. 15% book alternative minimum tax on corporations. Essentially, that sets a floor on corporate tax rates. As a lot of you know, the corporate tax rate is 21%, but with tax credits and other things, you can push the effective rate lower. This would put a minimum 15% tax measured on book profits, not taxable income. And that's important because obviously taxable income is more easily managed through, especially when we still have accelerated depreciation and other means to manage taxable income. Book, not as easy to manage under GAAP. And, this is subject to, public corporations with earnings over $1 billion over a 3-year running average. So again, with public corporations, earnings per share obviously is critical. And so they're less likely to manage it down to avoid this tax liability that could be imposed. So this will be interesting to see how this impacts some of the largest corporations in America going forward. One of the other things that has gained a lot of traction is the stock buybacks that a lot of companies do, a lot of public companies do. There is now going to be a 1% excise tax on stock buybacks. A lot of details there that net the impact of stock issuances and other things. But again, there's now this excise tax that companies need to be mindful of. $80 billion towards increased IRS enforcement. That sounds like a lot of money. I think the service will be hiring a lot of agents as a result. But there's also a lot of press out there that notes there's a lot of agents retiring over the next several years. So while this money goes into play, it's going to be interesting to see how much that actually increases the examination rate, simply because I think there's going to be a lot of attrition in the workforce at the IRS, and so they may just be playing catch up as much as anything else. And then obviously the Inflation Reduction Act included numerous climate and clean energy credits and incentives, which may or may not be beneficial to a lot of different individuals and corporations out there. All right, moving on. So again, I wanted to touch on the qualified small business stock. I think the last time we did one of these presentations, this was, quite the hot topic because of proposed rule changes that were out there. Not as much going on this time, but I still wanted to revisit it. The QSBS or Section 1202 stock, as it's referred to, because again, it's important that we be mindful of it because of the potential benefit. Sometimes I see funds maybe not doing all the diligence because there are a lot of rules and other things to ensure that we get this treatment. And so it's important that funds stay on top of these things and ensure that they're tracking all of the myriad different things that you have to make to ensure that you qualify for 1202 stock. But real quickly, why is it beneficial? As many of you know, there's a large gain exclusion, greater of 10 million or 10 times the adjusted basis of the investment. So, significant upside. And that's only grown over the years. These rules have been out there for a long time. And so up till early 2009, it was a 50% exclusion. For about the next year and a half, it grew to a 75% exclusion. And thereafter, really since 2010, for investments acquired after that date, you have a 100% exclusion. If any of you were familiar with some of these transactions back pre-2010, you might know that there was an alternative minimum tax offset. So you might have a gain exclusion, but you'd be paying some alternative minimum tax to offset and net that benefit. The 2010 and thereafter rules give you the full exclusion for both regular tax and AMT. So it's obviously a significant upside and provides tremendous value in certain circumstances. One thing I did want to highlight is, be mindful of the fact that 1202 is a federal rule, and for the most part, most states conform to that. But there are certain states, for example, California, which do not conform to that. So you want to be mindful of these things as you think about the tax burden with something that is considered to be qualified small business stock. All right, last slide here before we move on to our next polling question. So again, I wanted to revisit the issue of potential change. We talked about it with carried interest and what might be happening in the future, likely to be some erosion of those benefits. I think 1202 is probably heading in the same direction, unfortunately. Again, as this presentation drove home last year, the Build Back Better Act was going to significantly curtail the benefits of Section 1202. Specifically, it would have eliminated both the 75% and 100% benefit for taxpayers with adjusted gross income over $400,000. So obviously that would have captured a vast majority of those who would otherwise be taking recognizing benefit under Section 1202. And of course, as part of that, we saw cap gains rates under that act that would have potentially been increased as well. So, we again sidestepped those changes last year, but I think it's important that we be mindful that, again, these are going to be bargaining chips going forward. And I think along with carried interest, I think 1202 might also be something that we could see changes to in the future. And with that, I will turn over to Danielle for the next polling question.
Jason, polling question number 2. Do you think we will see a continued erosion of the carried interest benefit? A, yes. It is just a matter of time before it is all taxed at ordinary rates. B, yes. But at worst, they will just lengthen the hold period. C, no. Lobbyists in favor of historic carried interest rule always. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We'll go ahead and leave this up for a few more seconds to allow you to respond. And here are our results. Jason, I'll let you make a few comments.
Yeah, I think this reflects the reality of it. I do agree that it's just a matter of time. Again, it's such a hot button topic. It's always referred to as this big loophole that only benefits the rich. And so we'll have to see. Only 14% think the lobbyists will always get the job done. We'll have to see. I think, obviously, we saw some upside to whatever was going on behind the curtains with the Inflation Reduction Act, where those things got pulled at the end. So time will tell. All right, with that, I will turn it over to Stu and Brittain for an international tax update.
Thanks, Jason. Hi, everyone. I'm Stu Myhill. I'm a partner in our International Tax Services Group. And presenting along with me today is Brittain Cunningham, who is a director in the International Tax Group. Next slide. So our agenda for the international part of today's discussion, first we're going to talk a little bit about Schedules K2 and K3. Next, I'll turn it over to Brittain, and Brittain is going to talk about some new foreign tax credit regulations that recently came out. And then Brittain is also going to talk about changes to the taxation of U.S. investors in indirectly owned foreign corporations, meaning that their ownership is through a partnership or fund. So just a real quick refresher on K2 and K3. So K2 was a supplemental schedule to Schedule K in a partnership tax return, and Schedule K3 was a supplemental schedule to K1s that went out to partners or investors. 2021 was the first year that we had to deal with this, so we did a significant amount of work in 2021 preparing initial year schedules K2 and K3. The purposes of these schedules are really to provide information to the partners that they would need to do international tax calculations at their level, such as, for example, a foreign tax credit, or whether they have to file a tax return in the U.S. for U.S. effectively connected income or passive income that's sourced from the U.S. This really presented a lot of burdens on taxpayers in the 2021 season. So as a result, the IRS actually granted some relief that sort of provided certain situations where people were exempt from filing or only had to file limited information. As we stand right now, we do not expect this relief to continue into 2022. So we do expect that some taxpayers that avoided having to do this in 21 under the relief will have to do it for the first time in their 2022 tax returns. So a few observations just from looking at all this stuff for the 21 tax year. Nearly all partnerships and S corporations have to complete one or more parts of the forms. One big misunderstanding was, a lot of people would say, well, my fund doesn't have any international activity, so why do I have to do this? And you still have to do it because the relevance of needing this information is determined at your investor level, not at your level. So you may have an investor who has to do some international tax calculations because of their personal situation or other investments that they have, and they still need this information from your fund, even if your fund itself has no international activity whatsoever. The schedules attempt to provide all the information that an investor would need. So they're very robust and voluminous. And what we found is, a lot of the information provided really isn't needed by some investors, but the way the law is written right now, we have to complete these. So it remains to be seen if they'll start to provide any different relief now that the general relief is expired. It just seems to us that we're having to, do a lot of this work unnecessarily, but that's just the way that they've designed it. So with that, I'm going to turn it over to Brittain, and he's going to talk about the new foreign tax credit regs.
Yep. This year in January, we got final foreign tax credit regulations, and these are going to be applicable primarily for most taxpayers for tax year 2022. And what these regulations do is they place additional limitations on which type of taxes could be creditable from a U.S. tax standpoint. So historically, foreign taxes needed to be income taxes in the U.S. sense. These new regulations put additional limitations that really test the taxes for whether or not they're levied on taxpayers in the same way as the U.S. would levy tax on similar type income or with respect to a particular type of taxpayer. So some key observations for this, that this really pushes the analysis for investments in foreign, companies. Fund managers should consider this more on a country-by-country basis as a result of these regulations. We do think there is some relief available under treaties, but that is ultimately a country-by-country analysis. And I'm going to talk a little bit more in detail about this here on the next slide to help explain and talk about it specifically with respect to capital gain income. So, imagine a typical scenario: U.S. investor in a U.S. fund. The fund invests in a foreign corporation. During the year, the fund sells shares in that portfolio investment. A foreign country, however, withholds on the proceeds of that sale, requires the buyer to withhold. The net proceeds go to the U.S. fund. distributed out to the investors potentially. But the investors have to pick up the capital gain income in the U.S., the U.S. investors do, calculated under U.S. rules. And potentially, hopefully, the investors would expect that to mitigate double taxation, maybe they could get a foreign tax credit for the withholding tax paid. And actually, to tell you the truth, under current rules, in this scenario, taxpayers are typically limited in their ability to claim the credit except for special circumstances. And that limitation is on the income side, in that the capital gain income is deemed U.S. sourced income in this scenario, typically because of the investor's residence being a U.S. resident. The sourcing rule does not look to the residence of the corporation that's being sold. To draw a line to the new, between the new regulations put an additional limitation, and now we're going to say potentially the tax itself could not actually be a creditable tax. And so while under current rules, the tax could at least, theoretically be carried forward as a credit that a taxpayer could use in the future, now even the tax itself could be non-creditable. All of that being said, I don't want to sound the alarm too loud, because we do, as I said on the previous slide, think that some treaties or treaties on a country-by-country basis will provide some relief, but that is going to require looking at those treaties. So we just recommend that when you're entering into investment in a foreign country, you consider the exit and of that investment and what taxes are going to apply at that point in that local country, and do that analysis up front to see whether your investors are going to be able to obtain, your U.S. investors, a foreign tax credit for those particular taxes that could apply at the foreign country level. Then moving on, we also got final regulations related to Subpart F. But in talking about these final regulations for Subpart F, we'd like to kind of talk about a trend we're seeing with respect to the taxation of foreign corporations and income of foreign corporations. Passive type income, offshore income has always, or not always, but for as long as I've been practicing and long before, subject to Subpart F and PFIC rules on passive type income, so that where to prevent investors from offshoring income, not paying tax, and indefinitely deferring tax on that income. In 2017, we got a new provision called GILTI, which basically puts a minimum floor of taxation on foreign income, not just passive income. And so what we saw in final regulations issued in June of 2019 with respect to GILTI is that where an investor holds their investment in a foreign corporation through a fund or U.S. partnership, the aggregate approach is applied in determining what the GILTI taxable income would be to a U.S. investor, meaning the U.S. investor does the calculation, the partnership just aggregates the information and reports it to the investor. At that time, we got proposed regulations related to Subpart F that would harmonize that treatment for Subpart F. And just this year, we got final regs that continue that approach to treat Subpart F the same. Now, these would not be effective until tax year 2023 for most taxpayers. So we have some time before they're implemented. But also, we got proposed regs related to PFICs, and specifically the elections we can make for PFICs that would also take the aggregate approach. So it really takes the partnership out of the process of calculating the taxable income to the taxpayer and pushing that calculation up at the taxpayer level. At this point, we don't know when those PFIC regulations would be final, but continuing the trend, it would seem that the IRS and Treasury would move in that direction to finalize the PFIC regulations, so all of these deemed inclusion provisions are consistent. So going into to specifically level set on where we are with respect to each of these, on GILTI, we currently use the aggregate approach. Those are already effective for this year, which means the partnership reports the aggregate GILTI amounts information to its investors, and the investors can do the calculation themselves to determine whether they're taxable on GILTI, have a GILTI taxable income inclusion. For Subpart F income, currently the partnership does the calculation, determines the Subpart F income, and then the Subpart F income is allocated out to partners. The aggregate approach, which would be effective for tax year 2023, would now have the partnership passing along information needed for the investors to be able to do the calculation at their level. In the interim, the fund can choose to follow the new approach or can continue to calculate Subpart F income at the fund level and allocate the income to its investors as long as subject to a consistency requirement. And then finally, for PFIC, under current rules, the U.S. fund can file a Form 8621 itself with its 1065, make elections under QEF and mark-to-market, generally beneficial to taxpayers. They can do that election on behalf of investors, and then the investors are not having to do the Form 8621 in their own tax return and make these elections themselves. But under the proposed rules, these elections would all be required at the individual investor level, pushing down all of this additional compliance and analysis to the individual investors. So just some observations on these new rules, starting with a third bullet point, because the first two we've kind of already covered. The new rules are going to, of course, add complexity to the maintenance of partner capital accounts, because the partnership will need to capture information as to whether or not individual investors have made the elections or not, or whether they've had inclusions with respect to Subpart F or GILTI. Investors that are not, and this is positive, development, investors that are not in their own right U.S. shareholders, generally greater than 10% owners of the underlying foreign corp, wouldn't be subject to an additional income inclusion because at their level, they would not ultimately have a Subpart F income inclusion based on their own calculation. Under the current rules, the partnership determines it and just pushes that income out. So that's a benefit to the smaller investors in the foreign corp indirectly. The PFIC regulations, if finalized, are going to significantly increase the number of Forms 8621 that are going to need to be filed, now one with each individual investor, increasing the complexity there. Partnerships and S corporation shareholders are going to need to communicate back to the partnership. They're required to within 30 days of filing their return to and making an election for PFIC to provide that information to the partnership, although not providing that information would not invalidate their elections. All of this really emphasizes the importance of the Schedule K3 in reporting the necessary information to investors to do all of these calculations. And then finally, U.S. investors that indirectly own a PFIC really could lose their ability to make these elections if they don't make the election timely on a timely filed return. But fund of funds in particular may not be able to complete the international tax analysis until very late in the compliance process. So that puts pressure on the taxpayers to get the information and do the calculations and make these elections timely with their return. I think we have a polling question. Danielle?
Thank you, Brittain. For poll question number 3, what is the general sourcing rule of capital gain income from the sale of stock? What is the impact to a U.S. resident investor when calculating their foreign tax credit? A, generally sourced foreign if it is a stock of a foreign corporation. Therefore, the U.S. resident investor can typically capture a foreign tax credit for foreign taxes paid on sale. B, there is no general rule. It depends on the facts and circumstances. C, generally sourced country of residence of the investor. A U.S. resident investor would generally not be able to capture a foreign tax credit for foreign taxes paid on the sale. As a reminder, if you do have the option to submit questions for us in the Q&A window, we have quite a bit of content to cover today, so if we don't have time to respond during the webcast, We will do our best to follow up with you afterwards. And I'll leave the poll up here for about another 10 seconds as you respond. Here are our results.
And this is the reason for the polling question. The answer is actually C. Generally, this is sourced to the residence of the investor, and they would not be able to claim the foreign tax credit. It's definitely something to highlight and keep in mind when the fund is investing in foreign companies. And I think that we have Dylan next.
Yes, hello everyone. My name is Dylan Peters, and I'm a senior manager in our audit department in our San Francisco office, and I'm here to present an accounting and regulatory update for private funds. So on June 30th, 2022, the FASB issued Standards Update 2022-03, Fair Value Measurement of Equity Securities Subject to Contractual Sale Restrictions, which also updates the required disclosures related to such securities. The ASU clarifies that a contractual restriction on the sale of an equity security is not considered part of the unit of account of the equity security and is not considered in measuring the fair value, i.e., the entity shouldn't be applying a discount related to the contractual sale restriction. The ASU also prohibits the entity from recognizing the contractual sale restriction as a separate unit of account. The key provisions of the ASU are related to determining the unit of account, which is key when considering measuring fair value under Topic 820. Topic 820 currently contains some conflicting guidance on the unit of account when measuring fair value of stock with lockup or market standoff agreements. The current guidance indicates that the unit of account is an individual security exclusive of the contractual sale restriction. Thus, under 820, it would not be appropriate to adjust the fair value for the restriction by applying a discount to the price of an identical security that is not subject to the same restriction. In contrast, there are some illustrative examples within Topic 820 that address securities with these same restrictions, where the restriction would be considered a characteristic of the security and therefore included within the unit of account. In this case, potentially applying a discount would be appropriate. So the updated guidance has been released to reduce the diversity in practice and application and clarifies that a contractual restriction that prohibits sale is not a characteristic of the security and would be excluded from the accounting unit and measuring fair value. Further, the fair value should be measured at the market price of the same security being traded without the restriction, again, without adjustment or discount. The disclosures required by the ASU indicate that the fair value should be reflected on the balance sheet. The nature of the restriction as well as the duration should be disclosed within the notes to the financial statements, and also any circumstances that would cause a lapse in the restriction should also be disclosed. So the effective dates for adoption, it would be December 15th, 2023 and interim periods within those fiscal years for all public businesses. For all other entities, the amendment is effective for fiscal years beginning after December 15th, 2024. And again, for those preceding interim periods. Early adoption is permitted for both interim and annual financial statements that haven't been issued. The transition method for all entities except for investment companies is defined by Topic 946. The amendments should be applied prospectively. For all other entities which do fall under 946 as investment companies, they should apply the amendments to the investment securities subject to restriction on sale on the date that those are executed or modified after the date of adoption. Next, we have a few AICPA investment companies expert panel discussions from January and March 2022. These are non-authoritative guidance, but the first is related to the recognition of cryptocurrency transactions, which have been entered into before midnight of a reporting date, but not finalized until after. The members agree that the entities may need to engage legal counsel to determine the enforceability of the transaction, including the confidence and ability to close the transaction, which would, again, affect the recognition timing. Next, presentation of IRR for periods of less than 1 year. Generally, the panel agrees that IRR information should be useful and meaningful, and they discuss whether these should be de-annualized. I think the practice has been pretty common that these are annualized. They've come out to say that these should be disclosed as to how the IRR is going to be calculated and whether annualized or not. Again, more clarity. Last, we have a few regulatory updates from the SEC. I don't think we have time to get to them as we have to get to the final polling question, but within the slides, which will be available, there is a link to MA-authored alerts, which we've released in the last couple of months. So if you are interested, feel free to read those. Well, short and sweet, but thank you for joining, and we're going to go to our fourth and final polling question.
Thank you, Dylan. So polling question number 4, how well prepared is your fund to implement the SEC proposed rules impacting private funds? A, fully prepared, B, somewhat prepared, C, not prepared, or D, proposed rules not applicable. For those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email tomorrow, along with the webcast. Give you a few more seconds to respond here, and then we will move on to our results. And here's our results.
Thank you, Danielle. Thank you, Dylan. It's not surprised by the results there. There's a lot of updates coming out from SEC this year, and there certainly has been pushback, a lot of comments, as you can see some of the earlier proposed rules. So time will tell how this will all evolve, but the trend is clear that there is definitely more oversight coming from SEC as it relates to private funds and their investments. So with that, I will turn it over to Sheetal to take us to the end and close out the presentation.
Thank you very much, Syed. I'm Sheetal Sewal. I'm a tax partner in our private equity practice. I just want to thank all the speakers today and also all the attendees. Please reach out to any of us if you have any questions. We look forward to hearing from you. And I hope you found the information shared in this webinar useful. I also wanted to mention that we have our Alternative Investments Conference coming up in December. This is an annual conference. It's on December 7th and 8th, and we have a very good lineup of speakers and subject matter experts. So hope to see you there for our conference in December. And again, thank you very much, everyone.
Thank you. Thank you, Syed, Sheetal, and the team for a great presentation today. I also want to thank the audience for being engaged and submitting your questions to help guide today's conversation. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. So feel free to reach out to our presenters if you have additional questions. If you have CPE requirements, your certificate is available in mode now, CPE progress window. A copy will be emailed within 3 weeks. Should you have any difficulty downloading it now. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the console. Finally, here's a link to an online survey for today's presentation. Thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.